let me tell you about Gary. Gary is 57 years old, lives in Wisconsin, works in logistics, and he has done a lot of things right with his money. He has saved $350,000 for retirement. That is real. That took discipline, and he should be proud of that number. But here's the problem. That money is spread across 4 different places. An old 401k from a job he left 8 years ago, a Roth IRA he opened but barely funded, a brokerage account with a handful of stocks he picked during COVID, and a savings account earning almost nothing. Gary is not dumb. Not even close. He is overwhelmed. And because he is overwhelmed, he has not rebalanced anything in 3 years. He has not looked at his fees. He doesn't even know if his money is working together or working against itself. And that right there is the real danger. Most people think the biggest retirement mistake is picking the wrong stock. It's not. The biggest mistake is a setup so scattered that you stop managing it altogether. And doing nothing quietly becomes the most expensive choice you will ever make. So today, I am going to show you the exact framework I would use if I were building a retirement portfolio from scratch. It's called the 75-15-10 split. 3 positions, 1 afternoon to set up. And the part most people get wrong is the last 10%. You saw the thumbnail. VOO plus VXUS plus a question mark. That question mark is the reason this framework works for retirement. And it's the piece almost every video about this topic gets wrong. Quick note. I am not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, let me show you what I would put 75 cents of every dollar into, and why it might be the most boring and most effective decision you will ever make. The engine, 75 cents on the dollar. If I were building this today, 75% would go into one fund, one single fund. Either VOO or VTI. VOO is the Vanguard S&P 500 ETF. It holds about 500 of the largest companies in America. Apple, Microsoft, Nvidia, Amazon, Johnson & Johnson, all in one place. And it costs you 3 cents for every $100 invested per year. That's an expense ratio of 0.03%, almost free. VTI is the Vanguard Total Stock Market ETF. It holds over 3,500 companies. Everything in VOO plus mid-size and small companies too. Same cost, 0.03%. Almost identical performance over time.
Either one works. You do not need both. Pick one and move on. Now, I know some of you own SPY. A lot of people do. SPY tracks the exact same index as VOO, but it charges 3 times the fee, 0.09% versus 0.03%. On $100,000 over 30 years, that gap adds up to thousands. For a buy and hold retirement investor, there is no reason to pay more for the same thing. Here is the part that matters most for people planning retirement. The S&P 500 has averaged about 10% per year over the last 30 years, but that is the number before inflation. After inflation, the real return is closer to 7%. That 3-point difference is everything when you are planning real withdrawals in real dollars, and almost nobody mentions that. Now, here's a number that stopped me in my tracks. In 2024, the S&P 500 returned about 25%, but the average equity investor, they earned just 16.5%. That's an 8-point gap. 8 points. Not because they picked bad funds, because they panicked. They sold at the wrong time. They chased whatever was hot that week. And over 20 years, that kind of gap cuts your wealth in half. I'll show you the exact math on that later. Simplicity is the fix. One fund, auto-invest, and walk away. Back to Gary. He moves $262,500 into VOO. That's 75% of his $350. One fund, one move, done. But there's a problem. Right now, 100% of Gary's stock money is riding on one country, and there's a full decade of proof for why that's risky. The safety net, 15 cents goes global. This is the part a lot of American investors skip entirely, and honestly, I almost skipped it too. 15% of this portfolio goes into VXUS. That's the Vanguard Total International Stock ETF. It holds over 8,000 companies across more than 40 countries: Japan, the United Kingdom, China, Canada, Germany, France, all of Europe. One fund covers all of it. The cost? 0.05%. Still almost free. And here's something that surprised me. VXUS actually pays a higher dividend yield than VOO, around 3.4 to 3.4% compared to about 1% for VOO. If you care about income, that matters. But the real reason it belongs here is protection. Between the year 2000 and 2009, the S&P 500 did not just go flat like a lot of people say, it actually lost money. The total return, including dividends, was negative 0.9% per year for an entire decade. Most people don't know that. The number was not flat, it was negative. But during that same lost decade, emerging market stocks nearly doubled. International was the lifeline for diversified investors during those 10 years. Here's the myth. International investing is too risky for retirees. Here's the truth. Putting 100% of your money in one country is the bigger risk. Even Vanguard's own fund, designed for people already in retirement, keeps about 40% of its stock allocation in international. My 15% is below that, I know it. It's a deliberate choice, a home country tilt toward the US. And I'm being upfront about that because I think transparency builds more trust than pretending one number is perfect. Gary puts $52,500 into VXUS. That's 15%. Two funds, 90% of his money is now deployed, and it took about 10 minutes. So Gary has 90% working in two funds, but that last 10%, that question mark from the thumbnail, is the piece that turns this from a growth portfolio into a retirement portfolio, and you get to choose which version fits your life.
The question mark, your 10% edge. This is the part I have been building toward. That last 10% is your personal edge, and the path you choose comes down to one question. How many years until you start pulling money out of this portfolio? If the answer is 10 or more, you might lean toward the growth edge. If the answer is less than 10, you might lean toward the stability edge. Let me walk you through both. The growth edge is for investors who still have time and can handle some bumps. This is where you might put money into something like QQQM. That is the Invesco NASDAQ 100 ETF. It costs 0.15% and focuses on large technology and growth companies. Or VGT, the Vanguard Information Technology ETF, at 0.09%. If you want something backed by decades of academic research, look at small cap value. AVUV, the Avantis US Small Cap Value ETF, has outperformed the broad small cap Russell 2000 index by over 60 percentage points in the last 5 years. The small cap value premium is one of the most studied factors in finance. It is real, but it takes patience. It can trail the market for years before it pays off. And I know some of you are wondering about Bitcoin. Here's what BlackRock, the largest asset manager on the planet, found in their own research. A 1 to 2% Bitcoin allocation adds about the same risk to your portfolio as holding one extra Magnificent 7 stock. But a 4% allocation suddenly accounts for 14% of your total portfolio risk. So if you go this route, keep it very small. And know that Bitcoin's correlation with stocks has been climbing fast. Now, the stability edge. This is the retirement path. This is the version almost nobody builds for you. Think of it as 3 pieces working together. First, BND. That is the Vanguard Total Bond Market ETF. It yields about 4.5% right now and pays monthly income. It is the ballast, the steady piece. Second, GLDM. That is a low-cost gold fund. Now, gold does not pay any income, so why include it? Because gold shows up when everything else breaks. In 2022, stocks fell about 18%, bonds fell about 13%, both down at the same time. That was supposed to be impossible, But gold was roughly flat, and during the 2000 to 2009 lost decade, gold gained over 200%. Third, SCHD, the Schwab U.S. Dividend Equity ETF. It yields about 3.3% with 10 to 12% annual dividend growth. It gives you income today, and that income grows every year. This three-piece stability edge does something powerful. It smooths the ride, it provides income, and it protects you from the one thing retirees cannot recover from: selling your stocks at a loss just to cover your bills during a crash. Gary is 57. He wants to start withdrawals at 65. That's 8 years. He picks the stability edge, $35,000 split across BND, GLDM, and SCHD. Before I show you the setup, drop a comment right now. Are you leaning toward the growth edge or the stability edge? I read every single one. Gary now has a complete plan, 3 to 4 positions, 1 page, but a plan that lives on paper is worth nothing unless it runs on its own. And this next step is the one almost everyone skips.
Set it and walk away. Automation removes you from the equation, and honestly, you are the biggest risk in your own portfolio. Here is what I would set up this week. Not next month, this week. Step 1. Consolidate your scattered accounts into one brokerage. Fidelity, Vanguard, or Schwab all work. All three offer fractional shares starting at just $1. Pick one and move everything under one roof. Step 2. Place your assets where taxes treat them best. Put bonds in your traditional IRA. That interest income gets taxed at ordinary rates, so shelter it. Put VXUS in your taxable brokerage account. Why? Because you get a foreign tax credit on those international dividends that lowers your tax bill. You lose that credit completely if VXUS sits inside an IRA. Put your highest growth holdings in your Roth. That is where tax-free growth matters most. Step 3. Set up recurring automatic investments. Fidelity is the most complete platform for automatic ETF purchases. Vanguard works well for its own funds. Even $25 or $50 a month counts. Same day, every month. Treat it like a bill. Step 4. Rebalance once a year. Check your portfolio quarterly at most, and turn off your daily price notifications. I am serious about that. Now, let me show you why this matters. Over 20 years, $100,000 in the S&P 500 grew to about $717,000. But the average investor making the same investment in the same market, their $100,000 grew to roughly $346,000. That is less than half. More than half the wealth. Gone. Not from picking bad funds, from tinkering, from panic selling during dips, from chasing hot tips. And right now, there's nearly $8 trillion sitting in money market funds, a record amount. A lot of that belongs to good people who have the money but are too overwhelmed to move it. Too many choices, too many apps, too much noise. The 75-15-10 framework fixes that, not because the allocation is magic, because it is simple enough to actually follow when the market gets ugly. The quiet part. Gary did not find a secret stock. He did not time the market. He did not watch his portfolio every single day. He made 3 moves: VOO, VXUS, and his stability edge. He automated his contributions, he rebalanced once a year, and he stopped checking. That's the whole story. The portfolio did not make headlines. It just quietly worked, year after year after year. Wealth is not built by the investor who knows the most. It is built by the investor who touches the least. Now, if you know someone with money scattered across 3 or 4 different apps who doesn't know where to start, send them this video right now. It might be exactly what they need to hear. Tell me in the comments, how many accounts is your money spread across right now? No judgment here, I'm just curious. And if you're building retirement income and want to stay ahead of the moves that protect it, subscribe to this channel. I cover everything that keeps your money working while you go live your life. And if you want to see how SCHD, DGRO, and VIG stack up for retirement income, I'm breaking that down in the next one.